Yes, we are here. So we actually have learned this topic first time when you learn accounting one. So therefore, okay, so I will have a different focus this time. Yes. Now, yes, maybe let's first of all go back to our PowerPoint notes here. Yes. Now we said, well, we need to learn how to analyze a set of financial statements, right? So what do we have to analyze? Now, three things. Number one, the balance sheet. Number two, the income statement. And number three, the cash flow statement, or called the statement of cash flow. Now, we've learned a lot to analyze the income statement and balance sheet already, I believe, in the previous course, right? So therefore, yes, I would like to start with this statement of cash flow. Yes. Now, this is quite just a standard one, okay, a standard statement of cash flow, okay, but I would like to show you another one, okay, yes, and one that can easily understand the format or also okay, understand what are included in the cash flow statement. Okay, let me show you this one. This one is basically the same as the previous one, same as the one in the PowerPoint notes here. Okay, basically the same. Okay, yes. So let's see again what we can find from the cash flow statement so that we can know more about the company. Yes. Okay. Now, first of all, you'll find out that there are altogether 4 parts on the cash flow statement. We have the operating activities, investing activities, financing activities, and an analysis of the change in your cash position. So I would say the first 3 parts are larger parts. The last one is just a small part, okay, or not so important part. Now, let's first of all go to the first 3 parts, okay, which are more important, like what I said, okay. So let me repeat one more time. I believe you've learned that already, but okay, let me repeat one more time. What are these operating, investing, or financing activities? Yes, ready? Okay. Now, what are operating activities? Let's assume, first of all, okay, we work for Toys hours. Toys. Okay, it seems that I have a problem. Seems that my computer is not that stable from time to time these days. Okay, now yes, let's assume we work for Toys hours. You know Toys hours, right? So it means they buy and sell toys, right? Yes, you go to the mall and you should be able to find yes, the Toys hours very often. Yes, they buy and sell toys there. Now, what are operating activities? It means, well, yes, they buy toys, right? So therefore, they need to pay money. They sell toys, so they will receive monies from the customers, right? Where do they buy and sell toys? In the mall, in the shopping mall. So they need to pay rent. They need to pay, say, electricity charges. They need to hire people and pay salaries, right? So all those things that I've just mentioned are operating activities, okay? So it means, well, whenever you talk about the money you pay to buy the toys, the money you receive from selling the toys, the money you pay for rent, the money you pay for salaries, all those are here. Okay, so that's why you can find these things: receipts from customers, payments for merchandise, and payments for other expenses. Now, some of you guys may say, it looks like an income statement. Is it an income statement? I will say it's not. It's close to an income statement, but it's not exactly an income statement. Why? Because, well, just say, let's say, sales could be $100. I want to make things simple. But the money you receive from customers may just be $80, which is a different number, a number which is different from the income statement. Why? Why you actually sold $100 of products, but you receive only $80 is because some of those customers still haven't paid you the money yet. They owe you those money. It's not unusual, right, to have customers who owe you the money, right? So therefore, this number on the income statement could be, or very often, they are not the same as the number here, because the number here is telling you exactly how much you receive from the customers. Now, same for payment, okay? So you buy those products, say $70. So it means, well, yes, you have $70 of purchases, but how much money you pay? You might just have paid $60. Once again, it's because, well, you owe them money, okay? You buy the product, but you're not paying the money right away. So therefore, you owe some of those suppliers money. So therefore, even though on the income statement you said you purchased $70 of products, but you pay only $60. So it means all these numbers are slightly different from the numbers that you can find from the income statement, because these numbers are the actual money you receive, actual money you pay. Okay, and we want to know this information. Okay, yes. Any question? So it means that this part is telling you, okay, so what happened, okay, on your day-to-day operation, how much you receive, how much you pay, okay, in your day-to-day operation. Okay, yes, it seems that you have a question. Yes.
Yes, please. Where do we factor in the discount? Should it be part of the total sales or receipt?
Now, a discount, so normally a discount will be a netting of the sales amount, okay, and also it will be netting of the receipts from customers. Yes, if you talk about discount. Yes. Here. Okay.
Hello, Professor. So you are saying that this amount here, this sales of $80, it's the cash you have actually received after discounts plus credits and everything else.
Yes, after all those things. Yes. And actually on the income statement, okay, the sales amount is also after all those things, right? After discount, other things. Okay. So the difference between, okay, remember the income statement here is, so the income statement is showing you, okay, so what has happened, right? Oh yes, I've sold $100 of products, but here is what you have received or what you have paid. Okay, so therefore numbers are slightly different. Okay, and I'd like to know this number, okay, because I want to know exactly how much I can get. I mean, how much cash I can get after running my business for 1 year. Okay. So it means that, well, even though it shows, okay, I have this much extra in my pocket, right? So it means, yes, I have an inflow, meaning I have extra money here, right? Does that mean this is my profit on the income statement? No. Okay, so my profit figure on the income statement might be $30,000. Yes. I know I made a profit of $30,000 on the income statement. But when I read this report, I found out that I have actually got $10,000 extra in my pocket. Okay. Then you know how much actually you can spend, right? Though you made a profit of $30,000, actually you have only $10,000 extra, and it means you can only spend $10,000 extra, right? Not 30,000. Okay, so that's why we need to spend time to prepare this report. Okay, and that's why when you read this report, you know how much money you can spend. Okay, it's not the profit figure. Okay, the money that you can spend is not 30,000; it's only 10,000. Okay, because some of those customers haven't paid you the money yet, right? All these things. Yes. So that's why we need to learn, okay, to analyze a cash flow statement like this one. Okay, now we know. Okay, yes, by reading this, okay, you know, okay, things are different from what we learned from the income statement. Okay, even though we say we earn a profit of $30,000, but we only have $10,000 to spend. Yes, it's true. Okay, yes, that's operating activities. Now let's see. Okay, what's next? Okay, yes, we have two more parts. Now the next part is investing activities. Now, just like what we learned from financial management, when we say investing, it means investment, right? When we mention investment, there are always two types of investment. We have external investment and internal investment, right? So it means that whenever you have external or internal investments, you're putting these here, okay? So when you're making the investment, you need to pay the money here, okay? Then you're putting the money you pay here. But sometimes, okay, so you sell it, right? You can buy it, you can sell it, right? Yes, of course, right? It's a free world, right? So therefore, if you sell it, you receive money. So therefore, we have two sides of the story. So when you make investment, you will pay the money. And when you sell those investments, you will receive the money. Okay, two things, okay? Two sides of the story. Okay, yes. So it means whenever you are making investment, okay, no matter it's internal investment or external investment, you're putting that here. Okay, so that you know, okay, where have your money gone? Okay, so just like here, okay. Oh yes, I've spent some of my money on buying new investment, that is a new machine. Okay, and on the other hand, okay, I also sold, okay, some old machine and got these money. Okay, then you have a better picture of your operation, right? Okay, that's investing activities. Okay, So you know more about your investment, how much you pay to buy new investment, okay, and how much you receive, okay, by selling all the investment. Okay, so you know all those things, okay, about your investment. Okay, you may buy, you may sell. Now you know, okay, how much you pay when you buy, how much you receive when you pay, when you sell. Okay, that's investing activities. Okay, now the next thing, okay, that you want to know more about your company is financing activities. Okay, so it's about your long-term money. Remember what are long-term money? It means, oh yes, when you sell your common shares, when you sell your preferred shares, you sell your bonds, when you borrow long-term bank loan, then you can get money, right? You can get money from the investors or from the bank, right? So when you're getting money like that, okay, you are putting things here under financing activities. Okay, that's about long-term money, selling shares, selling bonds, or borrow long-term money. Whenever it's long-term, put them here. Okay, so then you know more about your long-term money. Okay, oh yes, okay, I just got some new long-term money, or I just need to repay those long-term money that I borrowed years before. Okay, yes. So then you know more about your operation once again, right? Yes. Okay. Yes. Now, how about the last part? Now, the last part is about just simple analysis of your increase or decrease in your cash position. You're just comparing how much you have at the beginning of the year to how much you have at the end of the year. You just compare. It's simple, really. Okay. So compare, and then you can tell, oh yes, okay, I have an increase or I have a decrease of cash position during this year. Just like here, the beginning is 163, right? And the ending is 158. So it means, well, you have less at the end, right? So therefore, I call that a decrease in cash, of course, right? It's as simple as this, okay? This is the last part, okay? Now, any question? Okay, now, maybe, okay, maybe put in some simple numbers, okay? Yes, or just look at the subtotals, okay? Yes, ready? Now, some of you guys may say, oh yes, okay, by reading the income statement, I found I made a profit of $30,000. We just said so, right? But how much do I have actually? Now, let's see. First of all, for the day-to-day operation, I got only 10,000, right? But for investment activities, I got 40,000 because I sold a lot of my investment, okay? And I need to repay my liability, my long-term liability. I need to repay this money. So therefore, at the end of the day, I have a decrease in my cash position, meaning even though I made a profit of $30,000, I have less money in my pockets at the end of the day. So by reading this report, you know why I made a profit of $30,000, but still I have a minus of cash position at the end of the year. Okay, because of these three things. Okay, because when I made a profit of $30,000, I got only 10,000 in my pocket. Okay, and then I got extra money for selling my investment, but I need to repay money. So therefore, I need to pay the money. So therefore, I have a minus in my cash position. Okay. Yes. So do you think you know more? Now, let me change the story a little bit, okay? So that, okay, so it could be more convincing, I think. Okay. You think it's not convincing enough. Okay. Now, let me make up numbers, okay? Okay, it seems I have a problem, huh? Okay, I simply cannot write things here. Okay, now, let me give you a more extreme example, okay? Now, okay, I hope it can be easily understood by you guys, okay? Now, is that when I read the income statement, I found I made a profit of $30,000, okay? So common sense told us that I'm supposed to have $30,000 more in my bank account, right? But when I check my bank account, I found I only have,
3,000.
yes, I only have $3,000. Okay, now let me write it here. Okay, yes, my computer is really not stable. So you guys may ask, okay, so where are those remaining $27,000? Okay, so therefore, if you read the cash flow statement, you can answer the question. Okay, that is, even though you made a profit of $30,000, okay, I only have $3,000 more in my bank account, because when I run my business for one whole year, okay, I actually got only $10,000 extra, not $30,000 extra. Okay, and then I need to make investment of $2,000. And then I need to repay my liability for $5,000. So therefore, 10,000 minus 2 minus 5,000 is 3,000. So it means at the end of the year, I only have $3,000 more, not $30,000 more. I hope this is more convincing, because sometimes plus, sometimes minus, okay, can confuse you. Yes. So then you can answer your question. You know more about your company. Number one, okay, you know that even though you made a profit of $30,000, you will not have $30,000 more in your bank account. You will not. Okay? This will tell you how much more exactly you will have in your bank account. Just $3,000 more. Okay. Why $3,000 more? Now we've listed that out, but with 3 subtotals. Okay. It's because, okay, the operation activities, okay, can make you have $10,000 more. You make an investment of $2,000 and you repay your liability for $5,000 more. So therefore, at the end, you only have $3,000 more. Okay. Yes. So by reading this, you really will know, okay, more about your company. Okay, so how much money you can spend if you make a profit of 30,000? The answer is only 3,000 at the end. Okay, yes. Good, bad? Well, we can tell, right? If we read the cash flow statement, right? Okay, you guys may say not so good, I think, because well, I only have $3,000 extra. Okay, let's use the number that I made up. Okay, yeah. You may say not so good, right? Oh, I only have $3,000, and I would say maybe is not so good. Okay, but you can see it as a good thing. Why? Because if you're making investment, now this is the money you spend for investment, right? I just made the numbers up, right? Now, if you're making investment, you're expecting you can make profit from your investment, right? Yes, of course, right? So it means in the future, you're not making an investment again. So it means in the future, you will not be deducting $2,000 again. Okay, but instead, you're expecting to earn, say, dividend income profit from your investment, right? So it means, well, this number will turn in from negative number to positive number, agree or not? Now, how about this one? Now, we say we are using $5,000 to repay the liability. Is it good? Is it bad? Now, it could be a good thing, because if you repay your liability, it means that you don't need to pay the interest anymore, because you repay the liability already. It could be good, right? Yes. So therefore, for this, once again, okay, in the next year, you're not expecting it to happen again. Okay. But in the next year, you are expecting to save the interest payment, right? Because you don't owe those money anymore. So it means, well, even though you have a minus here, but it may mean an improvement in the future years. Okay, because well, you can make profit from your investment here, and you can save interest by repaying your liability here, right? So it means if you read these numbers, if you read the cash flow statement further, you can really know more about your company, not just for now, is for the future, right? Now, if you want to know more things about the future, now let's look at the actual numbers that we have in this report, okay, and see, okay, if we can learn more. Okay, now, let me show you another one. Okay, so messy there. Okay, now let me show you another one. Now,
Professor,
yes,
yes. So this is the scenario of like a 1 year, but I have a question. Like if in the coming years we have like almost the same scenario, like the income like this. So are we going to spend like it was wrote like $40,000 extra,
yeah,
and
now,
in which we got $10,000 to spend. So in the next year, if we got 10,000 again to spend or like to invest, are we going to invest those money or like just
Yes. Okay. Now maybe okay. That's a good question. Okay. So it comes to another point. Okay. When you read then the cash flow statement. Okay, is that well these are normally recurring, meaning it will repeat again and again and again. Right. Of course. Okay. So because you buy and sell toys, right? So in the next year you do the same thing, right? So you're expecting similar things will happen again and again in the future, right? Because it's operating activities, right? You buy, you sell toys every day, every year, right? You would do the same thing in the next year, right? Now, although we are not sure that numbers are exactly the same, at least we're expecting similar things to happen again, at least, right? Of course, because it's operating activities. But for investing activities, it's not recurring. Okay, that's what I can write. Okay, it seems that my computer is not stable. Okay, well, okay, what I mean here is recurring. Okay, I cannot write the whole word here. Okay, so it's not recurring because, well, now just imagine, okay, you will not be investing, okay, you will not, right? So you will only invest from time to time. Just like buying a new machine, you will not buy those new machines every year. You just buy them when you need them, right? So therefore, probably next year you will not be making the same investment, probably. Okay, and same for financing activities. Okay, well, I have a big problem. Huh? Okay. Even the writing is moving, okay, but the screen is not moving.
yes, we can see Professor.
Okay, now this is terrible. Huh? Okay, let me do this. Oh, it's still here. Okay, yeah, even I close the file, it's still here. Okay, now I have a big problem. Let me use PDF. Okay, let me use PDF. Okay, if any of you guys are an expert in computer, let me know what's wrong. Okay, no, I don't know what's wrong. Okay, why is it so? Even I close the file. Okay, so those writing are still here. I don't know why. It's so interesting, huh? Okay, now I have a PDF. Okay, I think it's better. Yes. Okay, we just talked about this one, right? Yes, just like what I said. Things are recurring here, meaning it will repeat again and again and again. Okay, these are non-recurring. We are not expecting it to happen again and again because we are buying new machine, let's say, okay? So you might just be buying those machines, okay, once in a while, right? Maybe, okay, the next time when you buy the machine will be 5 years later, right? Not next year, not every year, obviously, right? Same for making external investment, right? So you will not be making those investments every year, right? Only from time to time. So therefore, I'm not expecting these things to happen again. Okay, same as this. Okay, I'm not expecting to repay the money again, right? So sometimes I borrow money, sometimes I repay money, right? Sometimes I sell shares. So those things will also happen from time to time, right? Not every year. So that this is non-recurring. Okay, that's why I said, okay, when I made up the numbers, okay, so we are not expecting to have a minus of 2,000 again in the next year. No, okay, we are also not expecting to have a minus of 5,000 again in the next year. No, okay. So that's why I just said, okay, so yes, if you're reading this and doing an analysis, okay, you might say it's not very good this year with it because you only have $3,000 remaining after running your business for 1 year, only $3,000 left, okay? But in the next year, okay, you might still be able to generate new money for your operation, right? But you don't need to pay this money. You don't need to pay this money. So therefore, things may improve, right? Now, just like what I said, okay, I want to go here. Okay,
I'm sorry, Professor,
yes,
before you move, can I ask a question?
yes, go ahead.
Thank you. With the current scenario, the current assets is expected to increase and current liability decrease. Two questions from my side. The first one, where do we record the inflow from current assets, like the creditors? Where do we record the inflows? And then for the second one, which is more important in looking at the performance of an organization? When do we use cash flow? When do we use income statements? How do we combine both to make an informed decision?
Okay, now maybe, okay, let me answer the second part of the question first. Okay, so we always use a combination of all the income statement, the balance sheet, and the cash flow statement when you want to analyze a company. Always, it's always a combination. Okay, so it means those things actually relate to each other. Okay, so it means that you need to know all, okay, before you can conclude a company is good or bad. Okay, and to answer you the first part of the question, okay, so it's very technical. Okay, if you want to know exactly how to do the calculations. But to make it simple, okay, so to answer the question, if I want to know the things that have changed for the current asset item, all those, okay, it will be here, okay, here, all these things, okay, all these things. So yes, now, if you want to know a little bit more, let me tell you, okay, so things are very technical. Now, when you prepare a cash flow statement, okay, it's very technical, okay. So yes, if you're interested in knowing the details, okay, I'll let you have the details, okay. But here I want to just spend maybe 1 minute to quickly tell you the logic behind, okay. Now, to prepare a cash flow statement, okay, so you look at the balance sheet. So you're comparing 2 years of balance sheet, okay, this year and last year, okay, and then you put them in tables like this, okay. And then you analyze, just like what you said. How about the current assets? These are the current assets, right? We're doing the analysis like this. Okay, we are doing the analysis like this. Okay, that is why we are analyzing how much is the sales, how much is purchased. Look at this, right? That's, you can find these things. Okay, and after doing the analysis, then you know, okay, how much exactly you have received, how much exactly you have paid. Okay, so it's very technical. Okay, but just to summarize things in brief, is that you're comparing 2 years of balance sheet, okay, and then find out, okay, those things, okay, and then you can conclude how much you paid, how much you received, okay, just like how much you receive for selling things, okay, how much you pay for buying those products, okay. Yes, these are the current assets that we are doing things like this, very technical, okay. Yes, okay, very technical, really.
Okay, Professor, one
Yes.
last question, please.
Yes.
Just to understand clearly, the cash flow statement, from what you said at the beginning, is the cash we are receiving or the cash we are spending.
Yes.
So for instance now, excuse me, the sale of plant assets. Supposing we sold the asset from the screen that is on right now, supposing we sold that plant asset for 50,000 and we have received only 30,000. So on the cash flow statement, only 30,000 will reflect, but on our income statement, it will be 50,000, right?
No, not right. Now, on the income statement, it's not showing the selling price. The income statement is showing the selling price minus the cost. Okay, so it means that on the income statement, selling price of the capital asset, like you just sold an old machine, okay, the selling price is $100. And the cost of that old machine is, say, $60. Okay, then you have a profit of $40. So it means the income statement will show $40. Income statement is showing all the revenue and expenses. Okay, so profit looks like a revenue. So therefore, okay, so this $40 of profit will be shown on the income statement. Okay, but these $100 will be shown on the cash flow statement, because cash flow statement is all the money you receive or all the money you pay. Okay, so they are showing different things.
Okay,
Yes.
but supposing the person that bought it has not finished paying, the person has paid, let's say, $80. are we going to write $100 on the cash flow or $80 on the cash flow?
Oh, that for sure is $80 because the cash flow will really record exactly how much you receive. If you haven't received those monies yet, okay, then you will not be recording that.
Okay, thank you.
Okay, come back here.
But in the current year, we will not be recording that, right, Professor? Usually the cost is recorded at the time of purchase, right?
At the time. Now, so it means, well, the income statement will record the purchase at the time of purchase, okay? But the cash flow statement, okay, will be recording the actual payment you paid. Okay, so different things, right? Yes. Even though you purchase $70 of products, okay, but if you paid only $60, then you just put $60 here because it's a cash flow statement, meaning, okay, it's the actual money you receive and the actual money you pay.
Here, when we are referring to the actual money when we pay, that means the in the $70,000, the $10,000 we are going to pay next time, right? In some other
Yes.
future date.
Next year.
Okay.
Correct.
Then in the income statement, what do we record, Professor?
The income statement is purchase, right? On the income
So we
statement,
record-
okay, it's purchase cost, right? But here is the payment for purchasing merchandise. Different, okay? It's just payment. We are not using just purchase. We say payment, right? Same for sales, right? On the income statement, we say sales, right? But here we say receipts from customers. Okay, so it means, well, yes, different things, okay? So numbers are different. Yes. So it means
Yeah,
what we want the whole set of numbers, okay, which are actual receipts and actual payment. Okay, so that, okay, remember, okay, we want to know how much more money we can spend, right, after running our business for 1 year, right? So therefore, okay, you need to find out the actual money you spend here, there, everywhere, so that you can answer your own question, right? So how much more money you have, okay, or how much money you can spend in the future, right? Yes.
thanks.
Okay. Now remember, okay, the profit cannot tell you, okay, how much more profit you can get after running your business for 1 year. Okay, you cannot. Okay, but this one can. Okay. Okay. Now, I want to let you know more. Okay, just a little bit more. Okay, about reading a cash flow statement. Okay. Now, we just said, okay, so a cash flow statement is different from an income statement, right? So even though the income statement shows you that you made a profit, okay, but no, you cannot have extra money after running your business for 1 year. Look at this, right? You even have less money after running the business for 1 year, even though the income statement shows you that you have a profit. Okay. Now you may say, well, then this is no good, right? Because, well, based on this, okay, so it's a minus here, is a minus here, and is a plus here, but on the whole, it's a minus. Does that mean this company is no good? Because, well, I have an overall minus of $18,000 at the end of the year. So it means after running my business for 1 year, I'm not gaining any cash. I'm losing cash. I'm losing $18,000 of cash. Let me tell you, okay, we look at things this way. Okay, now, this cash flow statement actually can tell you more about the company's operation, not just how much you receive, how much you pay. Now, the structure of the cash flow statement can actually tell you some exact actions that the company has done. Now, what exact action? Let's look at this. Now, these two actually relate to each other, agree or not? They both refer to the machine, right? But here, you paid money to buy new machines. And you sell your machine and got this money. So what does that mean? You think you can tell more after knowing these two lines? The
Yeah,
answer is yes.
Professor, I would
Yes.
say, yeah, it's like an investment companies make usually at the first year, just to invest for a long run. So of course they will have more expenses in the beginning.
Yes, okay, good guess. Okay, now maybe let me tell you. Okay, so yes, okay, so that's okay, that's right. Okay, that's good guess. Now I'll say, okay, now let's first of all assume that this is an old company, right? Now this is an old company, okay? Yes, because, well, they've already borrowed money, okay, long time ago already. Okay, so it's an old company. It's an old company. Now, this year, they spend a lot of money to buy new machines. So, what does that mean? It means they now are using new machines to produce the products. They can now improve the productivity. They can now improve the efficiency in the factory, right? So why I said so? Look at this, and you know exactly what happened. Because they are throwing away or selling those old machines. They buy the new machines to replace the old machine. And you see the action. I think you can see the exact action, right? They spend money to buy new machines, and then they sell those old machines. So it means what they obviously they can improve the productivity, right? Because they don't want those old machines anymore. Okay, they are buying new ones. Okay, so you can really see the actions. Can you see the action? I think we can, right? Now, let's look at here, okay? You can also see those actions, okay? Now, what happened here is, okay, I want to focus here. Okay, let's focus on here. Now, the first thing they're doing here is, I'm spending money to repay my liability, okay? But I'm selling new common shares. So what does that mean? I'm actually using the common shares to repay my liability. Is it good? I think it's good, because if you have liability, number one, you need to repay it sooner or later. No good, right? And also when you have liability, you need to pay interest every month, every year. No good, right? So now you're replacing your common share. I mean, you're repaying your liabilities with common shares, right? So it means from now on, you don't need to worry about repaying the principal. And also you don't need to pay the interest every month, every year. Good or not? I think yes, it's good. It's an improvement. So it means you have an improvement here, you have an improvement here. So when I'm putting these things together, you can really find the actions that I'm taking, and then you will find that it's an improvement, right? And then you know more, and then you can tell, you can conclude that even though, okay, so this year is not very good, okay, I have a minus of cash, okay, but I can tell, I can guess in the future, okay, so the company can improve its performance, right? Yes, question?
Yeah, Professor, the long-term notes payable are like for more than 1 year, I guess.
Yes,
So we can expect another payment in the coming year.
yes, but you have this, right? You have a lot
Yeah.
of common shares, right? So you could, that's why I
Yeah.
said you can see the action, right? So it means, well, okay, you can tell that, okay, so that the company is deciding to use the common share to replace the long-term notes payable. Agree or not, right? Yes.
Exactly.
So then
But Professor,
if you're preparing a cash flow statement like it, you can really, okay, so see the action that they're taking, right? It's just like the action here, right? Or the action here, right? Yes, go ahead.
is it appropriate to pay the long-term notes payable or dividends from issuing common shares? Because when you pay dividends or when you pay your debts, it has to be from the money which you made, right? Which you earned. From the analyzing point of view, is it the correct way to repay our debts by issuing common shares and getting money from that?
Okay, now this is actually another decision. Okay, so this is another thing. Okay, so now okay, so this is capital structure. Okay, so we'll be learning that maybe later. Okay, so that's in the later chapter we will discuss about this. Okay, so this is another issue. Yes, you're right. Okay, you need to raise that. But here, okay, so yes, okay, so here we don't want to make things too complicated. Okay, we just want to base on the cash flow statement and see what's happening. Okay,
Okay.
yes. Now this is what we can see, right? This is what we can see at least, right?
Yeah.
Yes. So now I think you will start to like to read a cash flow statement, because you can really know more about company by reading the cash flow statement, by analyzing a cash flow statement, right? So look at this video. Okay, I can see the actions really, right? Because when you prepare the cash flow statement, we need to put these things together. And that is the reason why we want to put them together, because you can really see the actions, right? What they are trying to do. Yes, to throw away those old machines and buy new ones so that they can improve the efficiency, right? And here, okay, so they repay the liability by issuing new shares, okay? So you can really see, okay, so what they are trying to do during this year. Yes,
Yeah.
right? Okay, yes. So I think that's enough, okay, for the cash flow statement. We spent, oh, yes, 40 minutes on this already. Okay, yes. So let's go back, okay, let's go back to the other two reports, okay, and see, okay, what other analysis we can do on the other two reports, okay. Yes, let's go to the income statement first. Okay, now this is the income statement. You guys may say, oh yes, okay, I can tell, okay, oh, how much money I earn from selling products, okay, what's the cost, what's the expenses, and finally, this is the profit, right? Yes, these are the things that I can earn. Now I'll say that's good. If you can mention those things, that's good, okay, but that's not good enough, because, well, you need to know more. You need to know more about the company by comparing the income statement to other years or even to other companies. Okay. Now, when we say comparing to other years, well, how to compare? Now, let me show you things here. Now, when you want to compare to other years, okay, you will really learn more about the performance of the company. Now, when you compare, there are different ways to compare. Now, let me tell you those ways one by one. Ready? Okay. Now, the first thing you can do is to do the horizontal analysis. You know the word horizontal, right? It means you're moving sideways like this. You're moving here like this is horizontal, meaning you're moving sideways, right? From left to right or right to left. So what does that mean when you're comparing 2 years of numbers? It means that you're comparing year 1 to year 2. Okay, yes. So what's the formula? What number we need to put together in order to find this 100% in red? Now, this is the formula. So it's year 2 minus year 1 divided by year 1. Year 1 is the older year. Year 2 is a newer year. Okay, so make sure that you know it, right? Because it's year 2. Of course, this is the newer year, right? So it means it's the newer year minus the older year divided by the older year. Okay, now let me show you how to do the calculation exactly for sales. So for sales is newer year is 200, right? Minus 100 divided by 100. So you get 100%. Okay, one more time. 120 minus 50 divided by 50 is 140%. So I believe that's, you guys have learned this from the previous accounting course, okay? I'm just repeating, okay? Yes. So here, when you use this formula, then yes, you can compare these 2 years and then you can conclude, okay, whether numbers have increased or decreased between year 1 and year 2, right? So here, okay, I can conclude that, okay, the year 2 figure, okay, if you compare the year 1 to year 2, okay, so yeah, so the it has increased by 100%. Okay. Yes. Here, it has increased by 140%, 60%, 50%, 62.5%. So these are the things that you can conclude, okay? Because I want to know, okay, so whether things have increased or decreased between 2 years, between this year and last year, so that I can tell whether I'm doing well or not, right? Because if I'm earning more, it's good, right? But when I pay more, of course, it's not so good, right? So then I can tell, okay, whether it's good or not good. Okay. So therefore, when you want to know your performance, okay, when you read your income statement, normally you won't read your statement just for that year. Okay. Of course, you will, you should, but well, besides reading that year's income statement, you also need to compare to other years, just like this, okay? So that you know more about your performance, okay? So that you know whether you're improving or not, right? Yes. Any questions? So then we call this horizontal analysis. Okay? We are comparing 2 years of numbers, okay, and conclude whether numbers has gone up or gone down. Okay. Okay. Now there is another way to do the horizontal analysis.
The professor, when we download statements from the the company's investor portal, these financial statements also include this percentage. In the accounting, we did the analysis, and these are pre-calculated numbers that already have been given by the company. So
Which one? Yes. Okay. So you mean the PowerPoint looks or which one? Okay, I'm not sure which one you're referring to.
this percentage, the 100%, 140% increase, or the
This.
Yes, this one. Yeah.
So you mean can you find it, or you
Yeah.
cannot find it?
Yeah. Yeah. I downloaded the financial statement for Bell Canada and TELUS. Both of these companies have already provided this percentage.
Oh, yes, yes.
Like for the
Yes, sometimes it's true. Okay, yes. Some companies would like to help you to do the analysis, so therefore you don't need to calculate by yourself. Yes, you're right. Okay, yes, it's true. Yes. For some companies, okay, it's not a must. Okay, it's not a must. But yes, for some companies, you're right. Good observation. Yes. Okay. Now let's move on to the next one. Okay, because well, not all companies will do so, so therefore you still need to learn. Okay, yes, of course. Now, the second way to move sideways, that is still horizontal analysis, is horizontal analysis method 2. Okay, so this is method 1. Okay, we know the formula, right? That is the newer year minus the older year divided by the older year. So how about the horizontal analysis number 2? For horizontal analysis number 2, you don't just want to compare 2 years of numbers. Look at this. You would like to compare a bunch of years, like 5 years, maybe even 10 years, really. Okay, so it means if you want to compare many years of income statement, you need to use horizontal analysis number 2. Now, when you use horizontal analysis number 2, the first thing you need to decide is to decide the base year. And the oldest year is always the base year. Base year. Yes. So let's assign the oldest year. That year 1 is the oldest in these 5 years, right? So what's next after knowing this is the base year? Then you compare all other years to year 1. And what does that mean? It means you divide every other years, like year 2, by year 1. Always divide by year 1. You divide year 2 by year 1, year 3 by year 1, year 4 by year 1, year 5 by year 1. You divide all other years by year 1. That's horizontal analysis number 2. Now, you even divide year 1 by itself, because you're dividing that by itself. So therefore, the E1 percentages are always 100%. That's why it's always 100, right? Because you're dividing 100 by 100, 50 by 50, 10 by 10, 40 by 40. Okay, so therefore you always have 100%. Okay, but how about the others? Let me work on others. Okay, maybe let me work on a couple for you. Okay, so here, like what we said, you would divide year 2 by year 1, right? So it means year 2 is 200, year 1 is 100, right? So it's $200 divided by $100, so you get 200%. This one is $300, right? $300 divided by the year 1 figure, $100. So 300 divided by 100 is 300%. So on and so forth. Yeah, if you want, you can compare other years as well. Okay, then you can find these percentages. Okay, so this is called the horizontal analysis method number 2. Now, when you are using method number 2, you know more about the performance of the company. Not just that, oh yes, the number has gone up or has gone down by this percentage, by that percentage. Now, these are the only thing that we can learn if you're using horizontal analysis number 1. But when you're using horizontal analysis number 2, you know more. Let me tell you, okay, so yes, what you can tell if you work out these things. Now, if you work out these things, well, actually, you can base on these things and draw a graph.
Professor,
Yes?
in the two analysis which we tried to understand just now, the first one we are trying to calculate the increase of the sales. In the
Between
second
year 1
one,
and year 2, right? Yes?
yeah. But in the second one, we are trying to find the third year how much of sales has happened, because here we are not trying to minus the year 1, year 3 minus year 1 minus divided by year 1. If we do that, we will calculate percentage of increase, no? But there is a difference between horizontal analysis 1 and 2. Is that correct, or?
It's not correct. It's not correct.
Okay.
Because now, yes, you actually raised a very good question. That is, well, okay, why I don't minus this and this, minus this and this. Okay, so it seems that by doing so, then I can tell the increase or decrease. Now, let me tell you, if you are comparing these many years, okay, at the same time, okay, and if you minus, okay, you will get a distorted figure. You get a distorted figure. Okay. Now, I'll let you know why. Okay, I'll let you know why later. Okay. Now, I want to move on first. Okay. So then I'll go back. Okay, and see. Okay. If you do the things that you have done here, okay, you will be distorting your analysis. Yes. Okay. Now, maybe. Okay. Let me come back here first. Okay.
Okay.
Now. Okay. Now. We said, okay, this is the formula. So it means you need to decide the base year, which is the oldest one, and then you compare all other years to the base year, meaning you divide all other numbers by the year one number, right? Then you get these percentages. Now, I want to base on these percentages to draw a graph. Okay, so the x-axis is the year 1, year 2, year 3, 4, 5. Let's finish this before we take a break, okay? So the x-axis is telling you the year, right? Year 1, 2, 3, 4, 5. And the y-axis is showing you the percentage increase. That's okay. Or the percentage, okay, on year 1. So for sales, okay, I want to plot a line for sales, okay? So I think the sales line looks like this, sales. Year 1 here, 100%, 200%, 300%, 400%, and 500%. This is sales. Now, by comparing all other years to year 1 and find the percentages, okay, and you can then draw a line on the graph. So what else can you tell about the company's performance? I can tell the trend in the past 5 years, right? Yes, I can tell the trend, right? So the trend all based on the percentages because I compare everything to the same year 1, right? Therefore, these percentages, okay, is actually telling you that comparing to this year, okay, so yes, I have these percentages, okay, so therefore, you can actually tell the trend that is it kept going up. Sales has kept going up, right? That's the trend. That's what you can tell. Now, sometimes sales may go down. Sometimes sales may go up and then go down, okay? So by using these percentages and plot the graph, you can tell the trend exactly. It can go up, it can go down. It can sometimes go up, sometimes go down. Yes? So therefore, this analysis, horizontal analysis number 2, can also be called trend analysis. Because it can really tell you the trend, right? Yes. Now, if you want to tell more trends about more items, yes, you can. Okay, let's try one more. Let's try the cost of goods sold. Now, for cost of goods sold, it also starts with 100%, right? And the next one is 240. 240 is more than 200, right? So therefore, my second one, okay, will be a little bit more than the sales, right? My third one is also more than the sales, right? So therefore, it's always more than sales. Therefore, based on this, okay, I can say this line is for cost of goods sold. Right? True? Okay, yes. So now, once again, I can tell the trend for another item that is cost of goods sold. So if you want to get, you can really draw a lot of lines, okay, and tell yourself, okay, so what are the trend for other items as well, okay? But let's stop it here, okay? I just want to talk about the trend for the sales and trends for the cost of goods sold. Let's see what we can conclude. Now, number 1, we can conclude that for sales and for cost of goods sold, okay, they both kept going up in the past 5 years, right? Yes, that's the trend, right? But is that all? Can any of you guys tell us more about the performance of the company besides this? I know, yes, that the trend is that they both kept going up. But what else can you tell? Anyone want to try? What else can we tell?
The profits, but the profit difference is been decreasing, I guess, Professor.
Yes, exactly. Now, because the speed, okay, of the growth of the cost is faster than the growth of sales. I'm not saying the company is losing money. Now, if you go back to these numbers, you know, the company has kept making profits. Yes, it's always a profit, right? I'm not saying it's losing money, but it's becoming harder and harder to make a profit. Agree or not? Because the growth of cost is faster than the growth of sales. So it means it's becoming harder and harder to make a profit. That's what we can learn from trend analysis as well, right? Because if you're putting different items together, you can have more conclusion. You can tell more about the company's performance. Now, what I learned extra is the company will find it harder and harder to make a profit, obviously, right? Yes, look at this, you know, right? Because the growth of cost is faster than the growth of sales. Yes, that's why we need to do this analysis. Yes, good, right? So you can put more together with it, okay? So that yes, you know more, okay? But yeah, okay, let's stop right here, okay? Yeah, you just apply the same logic, okay, on other items, and then you know more already, okay? Yes. Okay, now let me quickly, okay? Yes, so go back to, okay, so to your question, that is, so why don't we minus and work out the percentages just like before? Now, if you really minus, okay, this, okay, find the difference between these 2 years, okay, do the deduction here, minus here, okay, and find the percentages here. Now, your analysis will be distorted because, well, if you do the same thing like here, okay, so 200 minus 100 divided by 100 is 100%. Here, 300 minus 200 divided by 200 is 50%. 400 minus 300 divided by 300 is 33%. And 500 minus 400 divided by 400 is 25%. Now, let me tell you, if you really do this, okay, so these percentages are just restricted between these 2 years, okay? You cannot see these 5 years or analyze these 5 years altogether. Because if you want to analyze all these 5 years altogether with these percentages, you get the distorted analysis, right?
Professor, I think it's not year to year, but you can minus year 2 to year 1, year 3 to year 1, year 4 to year 1, and year 5 to year 1. And then you'll get the number.
Okay, now let me finish this first, okay? So if the video based on this, okay, so you'll find a downward sloping line, right? So that's not what to expect, right? Because what we just said, okay, so the sales has gone up, okay, in the past 5 years, right? It should not show you a line like this, okay? Now that's the first thing, okay? Yes, it's good to, okay, so to hear you mention the second thing, okay? That is, you can, okay, minus 3, okay, find the difference between year 3 minus year 1, right? Year 4 minus year 1, right? Or year 5 minus year 3, maybe, right? Year 4 minus year 2, right? Then you need to do a lot of combinations of calculations, okay? But still, you're confusing yourself because you have so many combinations, okay? So you really don't know, okay? So what to look at first? Now, let me tell you, that is the second advantage, another advantage of doing the second method like this. That is, after comparing everything to year 1, okay, these percentages are actually comparable to other years as well. So it means if you compare everything to year 1, because all of us compare to year 1, we have the same base. So therefore, you can compare year 2 to year 4 as well. Okay, so it means year 4 is worth 400%. Year 2 is worth 200%. So therefore, year 4 is twice as good as year 2. Okay, so you don't need to do the minus for every year, every combination. Otherwise, okay, so you might have 5, 6, or 7 combinations for 5 years, really, right? And if you have 10 years altogether, you might need to do 10, 20 combinations of calculations, okay? So that's not efficient, okay? So if you want to compare, okay, between any 2 years during these 5 years, okay, you just need to do one set of calculations. That is just compare everything to year 1. Then you're done, okay? You don't need to specifically compare year 5 to year 3, year 4 to year 2, okay? You don't need to. Okay? Otherwise, you have many, many combinations of calculations. No, we don't do this. I would say we don't do this, okay? If you want to compare these 5 years, you need to use method 2, okay? You use the same base, okay? And after having these percentages, okay, you can freely, okay, compare any 2 years. with these percentages. Okay, so that's the idea, okay, for using this the horizontal analysis.
Professor,
Remember, no. Okay, no. The answer is no. Yes.
what if the value of current year is lower than the value of base year?
Yes.
Then what?
So then, okay, so you, okay, let me give you an example. Okay, so just like here, okay, year 5, okay, all of a sudden, okay, we have COVID-19, right? So therefore, your sales have dropped to $80, okay, from 400 in year 4, all of a sudden to $80. Okay, that's really possible, right? Then, like what we said in the formula, is year 5 divided by year 1. Year 5 now is only $80, right? So 80 divided by 100 is 80%. So it means that the percentage for year 5 is 80% then. Okay. Yes. So then you can base on the percentages, okay, and that tell, okay, oh yes, okay, it was 400% in year 4, and all of a sudden it has gone down to 80%.
And using the first method.
Okay, you want the first method? Okay. Now for the first method, say 80. Okay. So okay, let me see. So if this is 80, right? Now it's 80. Oops. 80 is year 2 minus 100 divided by 100. Then you have minus 20%.
Minus 20%.
Minus 20%.
Oh,
minus means decrease, right? Yes, it makes sense, right? Because the number has really has gone down, right? So therefore the percentage should be a minus percentage, right? Otherwise, just like if you're increasing from 100 to 200%, this percentage is a plus. Okay, it's a plus of 100%. Okay, let me add plus. Okay. Otherwise, okay, just like what you said, then it's a minus 20%.
Yeah, with the method, with the second method, we don't get the minus percentage, right?
No, because well, you're dividing the actual numbers by this number, okay? Because you don't do the deduction, okay? So it won't happen, right? If you don't do the deduction, then you will never be able to get the minus, right? You're right, okay? So it's always a plus. Yes.
Yes. Okay. Okay, Prof.
Okay, now maybe let's take a break, okay? Yes. Okay. Yes. Sorry for the late break. Okay. Now let's come back at 9:14. Okay.
Thank you, Professor.
Thank you, Prof.
You. Okay. Yes. So let's talk about, okay, the first group of ratios, okay, that is short-term liquidity ratio. That is your ability to pay the liabilities in short run, that is less than 1 year. Okay, now the very typical ratio is this one. Okay? Once again, remember, okay, so I'm not going through all the ratios, okay, because it's very tedious, okay. So therefore, I'm just picking, okay, a very less important ratio so that I can explain you, okay, the concept. Now, the very typical ratio that can tell you the short-term ability to pay the short-term liability is current ratio, where we put the current assets and the current liabilities together. Okay. Now, you know what are current assets? They are the assets that you can easily convert into cash. You can quickly convert into cash. Now, let's go back to here and you know what are current assets. Yes, these are current assets. So they are cash, they are accounts receivable, they are inventory, right? So all these things can be easily turned into cash, quickly turned into cash, if we are not. Just like accounts receivable, they owe you the money. If they are good customers, they are supposed to pay you money within one month, 2 months, 3 months, right? And for inventory, okay, so yes, if those are good inventories, so normally you can sell it also within 1 year time, right? So therefore, yes, I would say, okay, so for all these, you can quickly convert them into cash. That's why they are current assets, right? So why am I putting these things together with current liabilities? Because these are the assets that you can easily convert into cash, right? So it means you have money now. You can have money very quickly. Why you want to know how much? Because if you have these monies quickly, then you can repay these short-term liability, right? Because they are short-term liabilities, you're required to repay those monies within 1 year. You need to repay those monies very quickly, right? So therefore, you need to find out those assets that you can turn into cash very quickly. They actually match with each other, right? These are the assets that you can turn into cash very quickly. Then you can use this money to repay the liabilities that you need to repay very quickly, right? Quickly means 1 year, within 1 year, right? So actually they really match with each other, right? So these are the cash that you can get quickly, okay, or assets that you can turn into cash quickly, okay? And compared to the liability that you need to repay quickly, okay? So what does that mean? It means these current assets have to be at least, okay, the same as current liability. So it means if current assets is $100, the current liability is also $100. So it means you will have just enough money to repay the current liabilities. So it means you need to have at least a ratio of 1. That is, you have just enough money to pay the liability. Of course, the more the better. And also, okay, of course, okay, we will not go to the extremes, okay? But 1.1 is better, maybe 1.2 is better. Yeah, have a little bit more current assets than current liabilities is better, okay? So that's the logic, okay, for calculating this current ratio, okay? Once again, okay, because I want to know whether I have enough current assets to pay the current liabilities. That's why I'm putting them together. That's why I'm expecting a ratio of 1 point something. Okay, so normally it's 1 point something. Okay, that is, I have a slightly more current assets than current liabilities. Then I feel comfortable. Okay, yes, I'm sure that I have enough money to pay the short-term liability. Then I'm fine, right? Any question about this? Okay, we're just doing revision, right? Yes. Now I want to remind you that yes, we will never go to the extremes, really. Okay, so it means well, sometimes you might say, then okay, 10 times is better. It's not true. Not true. Okay, because well, if you have too much current assets, meaning you have too much cash. Let's go here. Then you have too much cash. You have too much AR. You have too much inventory. Okay. Therefore, the ratio is 10. Okay, because if the ratio is 10, it means that the current assets is very big. Okay, therefore the ratio is 10, right? So what's wrong if you have too big a ratio, like 10? It means you have too much cash. Is it wrong to have too much cash? I would say yes, because if you have too much cash, it means you're not putting your money in profitable place. Okay, you're just putting your money in your bank account and earn 0.5% interest income. Okay, you should have put your money okay in the profitable way, like invest. Okay, somewhere internally, externally, right? So that you can earn more, right? And what if you have too much AR, accounts receivable? Okay, when people owe you money, okay, then they will pay you the money if they are good customers, right? But what if they are bad customers, right? Then you will lose money, right? So it means if you have too much AR, it means you have a bigger chance to lose money, okay? Because more people owe you money, okay? Then, well, maybe you have a bigger chance, okay? You have bad customers, right? And also you need to spend more time and use more resources to manage your AR. You have many AR, right? Yes, you might need to maintain a large accounting department. It's no good, right? What's wrong with the inventory when the inventory is too big? Okay, so it means well, you might not be able to sell all your products before the end of the season. You know, okay, so if it is end of the season, then no one would like to buy your products anymore because it's outdated already, right? So therefore having too much inventory may not be a good idea, right? So It means if the ratio is too much, it means you have too much cash, too much AR, too much inventories, which means not a good idea, right? You just mentioned the disadvantages, right? So yes, so therefore, okay, so we need to make sure that, okay, the ratio is more than 1, but we never want to go to the extremes, okay? So don't think 10 is good, okay? 10 is better. Okay? So 1 point something may be good. Now, you may ask another question, oh, 1 point something. Then I want to know whether it's 1.1 or 1.2 or 1.3 or 1.4 is the best. Can anyone answer the question? No one can answer the question because it all depends on your industry. Now, if you're running a different type of business, okay, so the ratios that you need may be different. Just like running a supermarket may be different from running, say, a real estate company. Right? Real estate means you buy and sell apartment, you buy and sell house. Okay? Then the kind of business is totally different. Okay, so then you might need totally different current ratio. Okay, so therefore, if you ask me, okay, whether 1.1 or 1.2 is better, I would say refer to the industry average. Okay, yes. So it means that you may go to the say the investment agency, particularly. Okay, so they have a lot of statistics. Okay, so they can tell you, okay, for this business, for this type of business in Canada, okay, this is the ratio. Say ratio is 1.5. Okay, then it's good to have the same ratio 1.5. Okay, because if you have a similar ratio, it means you can survive. Why? Because they can survive, right? Those other companies can survive with a ratio of 1.5. If you also want to survive, you also need to have 1.5. Another thing is, okay, if you have 1.5, it also means you are competitive in the market. Okay, because well, all your competitors have 1.5. Okay, so it's good to have 1.5 as well if you want to be competitive with them. So yes, I would say, okay, so too big a ratio is no good. Okay, don't go to the extremes. Okay, but well, the best ratio, okay, should be close to the industry average. Okay? And no one can tell an exact ratio for all companies. Okay, you always need to go to your corresponding industry average. Okay? You run a supermarket, okay, go find the ratio, the industry average for the supermarket. If you run a real estate company, then you need to go find the ratios, the industry average for the real estate company, so on and so forth. Okay, yes. Okay, now let's move on to the next one. Okay, that is the long-term solvency. Okay, so solvency, the word solvency is normally for long-term, okay, your long-term ability to pay the liability. So that's why I cross this out because normally, okay, so the word solvency is for long-term. The word liquidity is for short-term. Okay, so liquidity is the short-term ability to pay the liability. Here is the long-term ability to pay the long-term. So let's go find a typical ratio. Okay, so we do have typical ratios, which is this ratio. Okay, this is a typical ratio, and a lot of people like to work this out. Okay, so I personally don't recommend you to use this one. Okay, I'll let you know later. Now let me explain this one to you first of all. Okay, now what is this? Okay, now this is a little bit tedious actually. Okay, so we can make it simple. Okay, now before I tell you this, okay, I want to tell you a story. Yes, story. Okay, here I want to buy a factory. I want to invest in this factory. This is a factory. Now this is expensive. Okay, it will cost me $20 million if I really want to make this investment. Okay, let's see how much I have in my bank account. I only have $12 million in my bank account. So what should I do if I really want to invest in this factory? Tell me, what should I do? I need to borrow money, of course, right? Yep. So how much I need to borrow? 7 million? No. 9 million?
8 million?
No. Yes,
8 million.
Right. 8 million. So it means you will borrow just enough, right? Just enough. Okay. Theoretically speaking, of course, yeah. Theoretically speaking. So what does that mean? It means this factory is our asset, right? The money you have is your equity, right? Because you are now investing what you have. and you have $12 million, you invest $12 million. So it's your equity, right? And the money you borrow is liability, right? So what does that mean? It means the left side equals to the right side, right? That is, okay, if you want to invest $20 million, then you need to find $20 million, right? So where to find these $20 million? Some from your bank account, that's your equity, and some from borrowing, right? That's the liability, right? So therefore the left side always equals to the right side, okay? And actually we can create a formula like this. A, asset equals to L, liabilities, plus E, equity, right? Because of this, right? You look at the story and you know, right? That's, I can really create an equation like this. Now let's compare the equation here. To this one. TA, A is asset. TE, E is equity. A minus E is what? A. If you move E to the left, then you minus E, agree or not? Now, this is mathematics, right? It's simple mathematics. If you're moving E to the other side, you need to deduct, right? So A minus E is liabilities, actually. Yeah, making things a little bit complicated, really, okay? It's unnecessarily that complicated. So now we know, okay, when they say A minus E, okay, divided by A, it means liabilities divided by assets. Now, another question, why they want to say liabilities divided by assets? It's because of this. Now, I need to spend $20. I need to invest $20 in this factory, right? Yes, this factory is worth $20 million, right? So how much money is from my investment? Is divided by this, right? E divided by A, right? That is 12 divided by 20, that is 60%, right? Now I can answer the question. If I invest in this factory, 60% of the money are from me, from my investment. And how much is from borrowing? Then L divided by A, right? Is 8 divided by 20 is 40%. So now I can answer the question. When I invest in this factory, it's very expensive. Now I can conclude 60% of these monies are from me. 40% of these monies are from borrowing. Okay, so now the PowerPoint note is showing you the second one, 40%. Okay, because A minus E is liability, right? So actually, okay, is that I want to know, okay, how much is borrowed? How much of these investments is borrowed from other people? 40%. 40%. Okay, so here they work out 64%. So it means 64% of these monies are from borrowing. Now, by looking at this, okay, we can already have an idea of whether you borrow a lot or not, right? Because, well, when the percentage is big, okay, then you borrow a lot, right? When the percentage is small, then you're not borrowing that much, right? So you can have an idea right away, agree or not. So it could be 90%, okay, which is close to 100%. Then you can tell, oh, I borrow really a lot of money because it's 90%, okay? It could be 90%, right? So if you invest just, say, $2, 2 million, I mean, if E is 2 million, and if you borrow the remaining 18 million, then you get 10% and 90%. If you find out that your debt ratio is 90%, you can tell right away, right? I borrow really a lot, right? Yes, we can tell, of course, right? Because this debt ratio is always between 0 and 99%. It cannot be 100% because there must be some money from me, right? But it could be 99%. Okay, it could be nothing. I could borrow nothing as well, right? So therefore, the ratio must be between 0% and 99% when we talk about borrowing money, right? Now, this is the total debt ratio. Okay, it could be 0% to 99%. Okay, so by finding out the percentage, we can tell, we can have an idea right away whether we borrow a lot or not. Now, why I say this is no good? Because you divide the debt by equity, then you will have no idea of how much you borrow. Now, let's go back to here. So if you have this, and if you base on this, D divided by E, so D is liability, okay? So need more space. D is liability, okay, divided by E, equity. So in our first case, okay, so liability is 8, and my equity is 12, then it's 75%. But in my next example here, okay, liability is 18, my investment is 2, then it's 900%. Right? And let's go to the extreme. When liability is 19.9, equity is only 0.1. It still can make up a total of $20 million, right? But well, what I've invested is only $0.1 million. So if you divide this by this, you will get 1,990%. Now, what does that mean? It means by reading the percentage, you have no idea of how much you've actually borrowed. No idea. It can be 70%, it can be 900%, it can be 19,000%. I mean, yes, 19,000%. You simply have no idea when you read the ratio here, if you use this formula. But if you read this ratio, it's always between 0 and 99. Okay? You can tell right away. If it is close to 99, it's very big. If it is close to 0, it's very small. Everyone can tell right away the level of borrowing, right? Because it's between 0 and 99. But here, no limit. Okay? It can be 0, it can be 1 million. Yes, if you go to the extreme, it can be 1 million percent, really. Okay? Because you're dividing the debt, that is the liability, by equity. If you invest just $1, and if you borrow $1 million, then the ratio could be 1 million, right? So therefore, there's no limit really for this ratio. Therefore, you will have no idea of how much you borrow, actually. Agree or not? So therefore, okay, so I would prefer to use this one if you want to do an analysis. Okay, of course, okay, if you prefer, yes, there are reasons why people like to use this actually, okay. But I just say, okay, so if you want to have an idea of the percentage that you just worked out, okay, this is a better method. Okay, yes. So obviously, if you borrow too much, okay, so you will have a problem in repaying the money in the future, obviously, in the long run, right? Yes, if you borrow a lot, right? Okay, now let me quickly move on. Okay, so the next one is asset management, okay, or turnover ratio. So it means that, well, it's telling you how you manage your assets. So here. Now, let me give you an example of the accounts receivable ratio. Now, it's telling us yes, how you manage your accounts receivable. That is, when you're asking your customers to pay you money, the answer is 92 days. You're asking your customer to pay you the money 92 days after you sold the products to them. Okay? So you might say, okay, so what does that mean when it's 92 days? Now, because it's 92 days, okay, so you can tell yourself, okay, whether you have a good credit control. Okay. So it means, well, you should keep these number of days to a minimum. Okay. This is too much, okay, say 180 days, so then you don't have good credit control. Okay. because you need to make sure that, okay, you remind the customers to pay me the money earlier, right? Or on time, okay, according to the contract, right? So therefore, okay, if this is too long, it's no good, okay? So you need to make sure that, okay, so they are paying the money according to the agreement, okay? Say the agreement is 90 days, okay, then it's okay, then it should be 90 days, not 180 days, okay? So then you can tell, okay, your management, okay, of your accounts receivable. Yes, right? Now, another thing, okay, that is also about the management of your assets is long-term assets this time, okay? So that is you're investing, okay, in these many long-term assets, fixed assets, meaning capital assets, okay? How much sales you can generate with these assets. Okay? So it means you bought a lot of machines, a lot of equipment, right? So how can these machines and equipment help you to generate sales? Okay, so you work out this ratio. Okay, and then you know, okay, well, whether you're good or not. Okay? Of course, okay, just look at these percentages. It's not very helpful. You need to compare that to the last year. You need to compare this to the past 5 years. You may even need to compare to the other competitors or the industry average. Remember, yes, then you can have a meaningful analysis of this number. Okay. Okay. Yes. So yes, we can look at the efficiency of your long-term assets and also your short-term assets. Okay, now the next one is profitability. Okay, I think it's straightforward. Okay, yes, okay, so it means, okay, if you want to see, okay, whether you can make a profit or not, okay, so you go find these ratios. I think this is straightforward, right? So yes, the very typical one is the profit margin. That is, you compare your net income to sales. Okay, we did so already actually when we did the vertical analysis, right? So yes, by working those things out, okay, so then yes, you can tell. Yes, you can tell whether yes, your company is profitable or not. Okay. Yes, straightforward, right? Okay. The last one that I want to find out is the market ratio, market value ratio. Okay, just like this one, it's a very typical market value ratio. It's the PE ratio. I believe, okay, many of you guys know this ratio very well, okay, and also we learned that from the previous accounting course. This PE ratio is a price earning ratio. P stands for price, okay? E stands for earnings, price earnings ratio. Okay, so is that you're putting the price, okay, together with the earnings, okay? Let me put it here. Should be market price divided by earnings per share. That's the PE ratio. Okay, yes. Okay, now, one thing I want to remind you, okay, now this ratio is very, very special, okay, because we are putting different things together. Now, when we say the market price, okay, it's really today's price. So it means if you want to calculate the PE ratio today, you're putting in today's market price. It's easy, right? We have internet, right? So go to the internet, you can easily find today's market price, right? Yes, this is the market price you need in this formula. How about earning per share? Is it today's earning per share? No, it's last year's earning per share. Now it's year 2021, right? So when is the latest income statement? Obviously, last year's income statement, right? So it means when you do your analysis in the year 2021, okay, no matter which day you are calculating the PE ratio, okay, you are still referring back to the last year, that is year 2020's income statement, right? Which is the old income statement already, right? But you have no choice because well, those income statements will only come out once a year, right? So if you want a new one, you need to wait until the end of the year 2021, okay? Otherwise, if you want to calculate the PE ratio now, or the best you can do is to find the latest one, which is last year's income statement, okay, and calculate the last year's earnings per share. Okay, so it means you're putting different things together. This is the current information together with the past information. Yes. Now, you may say this is not accurate, it's true, okay, but at least, okay, yeah, so we can have some, yes, guidance, okay, to us to tell, okay, so yes, what's the ratio? Okay, then by judging this ratio, okay, so you can compare that once again to the last year and particularly to the industry average. Okay, so a lot of people okay, compare your ratios, okay, to the industry average, okay, and set the selling price of those listed shares, okay. So when those listed companies sell the shares, okay, so they like to calculate the ratios, okay, and then based on the ratio, okay, and set the selling price. Some of you guys may have that experience, okay. Yes, that's PE ratio. Okay, yeah, so yes, now we just have done the revision, okay. Actually, none is new to you guys, right? So we are just repeating the things that we learned from the previous accounting rules. Any question? Okay, yes, okay. So these are the things that I want to draw your attention. Anyone any question here? Yes. Okay, now maybe okay. So let's do a little bit of discussion. Okay. Yes, a little bit of discussion that I mentioned in the PowerPoint notes. Okay. So the first thing is, okay, so which theory or which formula, okay, is good, is the best, okay? So we say it really depends, okay? It really depends on your need, right? Remember, we say, okay, so if you want to find out this thing, then you need this set of ratios, right? If you need that thing, you need that set of ratios, really, okay? Or should I use the vertical analysis or the horizontal analysis? We also said, okay, so it really depends, okay? So my recommendation is, okay, so you need to combine all different analysis, okay? Do all the analysis, combine them, okay? So then you know more about the company, okay? So that's number one. And number two is benchmarking, okay? So that is, okay, so what you need to compare to, okay? Should I compare to the last year? Yes, of course, okay? And also, should I compare to the other company? Yes, of course, it's good, okay? But which company, okay? The problem is that, well, sometimes it's easy, sometimes it's hard, because if you're just running a supermarket, you can compare to other supermarket, right? But what if you are running different types of business? You might be running a supermarket. You might also be selling furniture. You might be selling electronics as well. You're running different types of businesses. Then your performance is a combination of different industries, right? Then it's hard to compare to any particular industry, because well, what you have on hand may be just, okay, or industry average just for electronic companies, and another average for just the furniture company, another average for just supermarket. But your company is running all types of businesses. So what can we do? Then sometimes it's really hard. It's difficult sometimes if you are a diversified company. Yes, right? Yes. And
Yes,
also, okay,
Professor, when I was comparing Bell with TELUS, their financial statements are consolidated.
yes,
So yeah, it was very difficult for us to compare because most of their operations are similar, but they were also doing different type of businesses as well.
exactly.
So it was very difficult for us. So yeah,
Right, right. Very
That
difficult. Yes,
can be natural ratios.
yes, that's true, right? Yes. On the other hand, okay, so they actually, okay, that very often, okay, they should, okay, they have the segment, okay, segment information. So it means that just on the other reports, okay, they would like to split their business into different categories, okay. So you can somehow you can use those information, okay, and compare. Yes, okay, but this too complicated for us, okay. I just want to let you know, okay. Yes, sometimes they have the segment information, meaning, okay, so they may actually they should break their performance up into different segments, okay, just like what we said, okay. So they have one segment for business, for supermarket, one for the furniture, and one for electronics. Okay? They should have that analysis in their annual report. Yes, okay, so that you can make use of those and compare. Yes, you can still compare to some extent then, right? Okay, now another thing is globalization. So it means that you might need to compare, okay, your operation in different countries. Okay, now the problem is because we are in different countries, you might have different accounting standards. right? Even though we said, okay, so we have IFRS, but we knew it already. Not every countries are using IFRS. We knew it already, right? So therefore, if you want to compare, just like if you want to compare things, okay, to the US, okay, our neighbor, okay, so it's not perfectly possible because they are not using IFRS, right? So therefore, okay, so the numbers that they report, okay, may based on different accounting standards, then different numbers, right? If you simply compare, so you may be, okay, also comparing the different results based on different accounting standards, okay, then you may not have a meaningful analysis because those accounting standards are different. Right? Another thing, okay, that you need to pay attention to is, well, sometimes we are using different accounting method, okay, just like first in, first out and last in, first out, right? Or when you calculate the depreciation, okay, you're using different depreciation methods, okay? So these are the things that are the potential problem that you might need to face. Yeah.
Professor,
Yes.
we don't use LIFO in Canada, right?
Correct. Remember, okay, this is not accepted by the IFRS.
Yes.
Not accepted by the IFRS. But again, the US, okay, they are still using their last in, first out because they are not using IFRS. That's why as we said, okay, so when you compare different countries' accounting reports, okay, so yes, we might have problem with it. Yeah, just like this, right? Okay, now maybe, okay, so the last thing I want to go to is just our discussion topic, okay? Just have a quick discussion, maybe, okay? So any of the groups, okay? Now maybe group one, okay? Yes, we have 4 groups here, okay? So maybe group one, okay? So can you tell us what are the big 3 rating agencies?
Okay, so we have Moody, Standard & Poor, and Fitch.
Yes, very good. I was wondering if any of you guys have experience in working with any of these companies? Not Moodle, okay? Moody, sorry. Okay.
Fitch, I've experienced Fitch, I think in the country where I came from, the global ratings that most of the financial institutions uses are Fitch. Fitch
Yes.
global rating. So with AAA, AA, or whatever they are rating them.
Exactly. So it means they will study your company and then they will assign a grade, okay? Yes, if you're good, AAA, okay? Otherwise, BBB, CCC, all those, yes. Or BBB plus or minus, all those subgrades as well, yes. Yes, right? So that's our job really, okay? So it means they're hiring a lot of people, doing a lot of analysis, okay, on almost every company in the world, really, everywhere, really. So then they will assign the grade, okay, and then okay, people will be using those grades, okay, and decide, say, whether I lend you money or not, or whether I charge you a higher interest rate or a lower interest rate. Because if you have a higher grade, of course, I may just charge you a lower interest rate, right? Because the risk level is low, right? But if your grade is only CCC, then I may charge you a higher interest rate because the risk is higher, right? Yes, yes. So once again, I was wondering if any of you guys have ever worked for these companies. No?
No, Professor.
Okay, yes.
No.
Now, I actually had an experience, okay, when I worked as an accountant, okay, I worked for quite a large listed company. So because I'm the accountant, of course, I'm the first one, okay, who know the profit that the company can make. Of course, okay, I'm the accountant, right? But I remember one day, okay, I got the phone call. I think it's from S&P, okay. I got the phone call from S&P, okay. Actually, that person from time to time, okay, called me up, okay, and asked for some information, okay, actually, because he did analysis on my company. So one day he called me up and said, Thomas, okay, I know your profit figure. I said, impossible, okay, because I'm the accountant, you're not, right? So of course, okay, I know my profit figure. You will never know, okay. And actually, I haven't worked things out yet. I said, okay, how do you know? Okay, you know the profit figure. He said, okay, when he works, okay, in the office, okay, he just studies 3 companies, only three. Okay, so it means every day he read the newspaper, read everything about those 3 companies, okay, so that he can understand those 3 companies, so that he can even guess how much profit I can make, really. Okay, so what I want to let you know is that they really spend a lot of time, a lot of money, a lot of resources on studying those companies. Yes, because what they really, okay, hire people, okay, to study just 3 companies. They're hiring a lot of people. Now, of course, okay, if they are studying smaller company, they may be responsible for 20 companies, 30 companies, I don't know, okay? But if they are studying larger company, they might just need to study 2 or 3 companies, really. They really, okay, hire a lot of people, spend a lot of time to study your companies, really. Okay, yes. So I would say to some extent, okay, these things are quite accurate to some extent. Yeah.
Sorry,
course.
Professor.
Yes.
Just from the side, how do they make their money if their job is just to study companies and rate them?
So because, well, yes, if you're a listed company, if you have big transactions, you need to announce those transactions. Yes. So based on those announcements, okay, so they can tell, okay, what's going on, okay, with your company.
No, I meant the like Fitch. So how do they make income if their job is just to study companies, analyze and rate them?
No, you need to pay money to buy the information, right?
But informations are available everywhere, right?
No, it's just AAA, right? If you want to know more, you need to pay money, okay, to get the more information, right? You cannot just say AAA, okay? So if you want to know more, you need to pay money, okay, and get the details, right? Yes. So it means they are selling their reports actually, okay, their analysis. Okay, if you want to get more detailed report, not just AAA or BBB, then you need to pay, okay, pay to them and buy, okay, yes.
Professor, how would we
Yes.
know who to which credit agency is better among the 3? Like our country is being rated by the 3 agencies differently. Like some said it's BBB and some said it's already AAA. I don't know, and so it's quite confusing. And so, which of the 3 do you think is more reliable?
I cannot tell. Okay, I think no one can tell really. Okay, but I would say these 3 are the most popular ones. That's why they are the big 3. Okay, so it's always true that just for Moody they may say you're AAA. Okay, but for S&P they may say you're just ABB. Yes, it's true. Okay, it's because different people do different analysis, so they may have different conclusions. Really. Okay. So the results are always not consistent. Really, that's true. That's true. Really. Okay, that's true. Okay, now maybe let's move on. Okay, so can group 2 maybe, okay, or anyone want to add anything to A? First of all, any other group?
Yeah, I'm Mahesh from group 2. I would like to add some points. Like
Okay.
Actually, these 3 agencies, like credit agencies, control 95% of the rating business.
Yes, true.
Yeah, the Fitch Group is actually located in London, and it controls 15% of the global market. And coming to the roles, I can say that these ratings are used in structured financial transactions like asset-backed securities, mortgage-backed securities, or collateralized debt obligations. And these agencies also give ratings to sovereign borrowers, like the largest borrowers in financial markets. And overall, we can say that these ratings provided by all these 3 big agencies also serve as the benchmark for financial market regulations.
Yes, yes. So then they sell the information, they sell the analysis, right? Yes. Yes, good.
Yeah.
That's good.
Professor, may I add also something for
Yes,
the
sure.
first point?
ahead.
So of the research I did last night, it said that, for example, in 2008 crisis, these rating agencies played a very critical and big role in the marketing of risky mortgage securities, and they helped so much United States bring back its financial system to its knees. So then these financial instruments were sold to investors.
That's very bad experience, right?
Yeah, the
Very bad.
crisis and everything. Yeah.
That's true. Okay, that's true. Okay, so it means sometimes okay, they look very reliable, right? Very reliable. They seem so they would do a lot of work.
Exactly.
Okay, but sometimes okay, just like what you mentioned. Okay, in year 2008. Okay, they said, oh, this is good, this is good. Okay, but finally you lose all your money. Really. Yes, it's
Yes.
true.
Yeah.
That's true. Just like
Thank
what we
you.
discussed last time. Okay, so can you fully trust the auditor's report, or can you fully trust anything? So the answer is always no, right? The answer is always no. Okay, so don't trust anyone. Okay, any agency, any organization, 100%. Really, right? Yeah, that's true. Okay, what we want to say is just in general. Okay, that's it works out like that. That's true. Okay, yes. You just brought out another thing that is about don't trust. Okay, these 100%. True.
Yeah, exactly, Professor.
Okay. Yes. Now maybe okay. So let's go to the next one. Okay. Let's finish off the things. Okay. Maybe group 4. So
Yes, Professor,
how?
from group 4.
You mentioned that actually, right? How?
Sorry.
Yes. Go ahead.
Yeah. So I think on this discussion point, I think you explained the whole ratios today, benchmarking with performance of corporation. So basically how you do it in our research is that we found that you do the analysis based on the published accounts. If you want to compare between different organizations, you can actually compare the ratios based on the industry and also based on the areas that you want to look for. For example, you could look for the liquidity ratios, profitability ratios, or you can look for the leverage ratios and efficiency ratios. Based on that, you can base your investment decisions for these companies. And those are the important ones that you could want to have these ratios tested on.
Good. Yes. Or any group want to add anything? Yes.
Yes. Group 1, Grace.
Okay. Go ahead.
I'll just mention one ratio, which is the profitability ratio. So we use that to like evaluate the how financially stable the company is, the profit the company makes. So by doing that, you can compare other companies by using their profitability ratio. So you get to know their net profit margin and their return on asset, return on equity, and all that to calculate their profitability ratio.
Yes. Yes. Good. Yes. Good. Okay. Now maybe let's move on to the last one here. Okay. That is C. Okay. Yes. Here. So who are the users? Now I want to be specific. You might say, oh, everyone, right? Now what I mean here is, let's say for the bankers, okay, which group of ratios are they more interested in? Okay, if you're the bankers, or what if you are just an investor, which group of ratios are you interested in? Okay, so that's what I mean here. Okay.
Yes, Professor.
Yes.
Except
Oh, maybe group 3 first. Okay, I want to start with group 3 this time. Yes,
yes,
group 3 here.
Professor.
Okay, good. Go ahead.
Who are the user of the financial statement information are the employers also. So we can consider in a customer, and competitors also, governments also took part in this investment analysis also, and investor and lenders also.
Yes. But can you answer my further question? That is, yes, I know, okay, so we have a long list of users. But let's say, okay, they are the bankers, okay? So which group of ratios are they more interested in? That's my further question.
Professor, I think the profitability ratio, I'm not really sure about it, but I think they're most interested in profitability ratio.
The banks or the
would be the
investment agencies would be interested in the solvency ratios and how much the companies are willing to pay their debt, like how in like the liquidity ratios. They talk about the immediate the ability that the company has to pay their debts, in what term they, in how much time they repay the debts. So the banks will be looking for that. So in my view, the solvency ratios as well as the debt coverage ratios, the banks will be looking at.
Okay, good.
Professor, may I add something for group 3?
Yes.
Yeah, Dafina here. So I think both, in fact, 3 of them, like profitability, liquidity, and cash flows would be those that the users must financial statement information and ratios.
You mean the bankers or all users?
Mostly the management team of the organization,
Okay.
the users.
Yes. Yes. But yes, okay. Now we just mentioned bankers. Okay, so how about the government? Now, the government is also one of the users, right? So what are they more interested in?
Professor.
Debt to
from
cash
group-
flow ratio, Professor. Quick ratio and debt service. Sorry.
Government.
No, sorry. I was answering about the bank institution.
Oh, okay.
Yeah.
For government,
Professor, I can answer for the government. I think the government will be interested in the profitability ratio of the company in order to determine how much tax they're going to give or tax rebate that the companies are going to get.
Yes. Good. Huh? Good. Now, what if I'm a small investor? I'm just a small investor. I just want to buy, say, 100 shares. So which ratios am I interested in?
profit and earning ratio, PE ratio.
Rather than earning. What else?
Is
You
it
may
price
discuss about that.
Price earning ratio.
Price earning ratio. Good. What else you're interested in?
For lenders.
Well, I'm a small investor. I mean, I'm a small investor. I want to invest in, say, okay, TD Bank's share, just 100 shares.
Profit to booking ratio, PB ratio.
The PE ratio, right? Just you mentioned that. And is there any other ratios that you
I
might?
was also
I
interested
think it
in
may be
the
debt to asset ratio.
Yes. Why? Why that ratio?
I just feel maybe debt to asset ratio. I can't really
Okay.
explain. Yeah.
Yes. Okay. That may be true. Okay. So you may say if you want to invest, you want to look at everything as well. Yes, it's true. Okay. I agree. Okay. But which ratio are you particularly interested in?
Dividend
Okay?
payout ratio, Professor. The dividend payout ratio.
Yes, okay. I think that's another thing you would like to look at is a dividend ratio as well. Yes, and PE ratio is good because it can tell you whether you're overpaying or not. Okay, the other ratio is dividend because after buying the shares, okay, you're expecting to earn a dividend every year, right? So you want to know, okay, whether they pay a lot or they don't pay a lot. Then by calculating the dividend ratio, then yes, you have an idea. Okay. Okay, now I think that's almost all that we want to learn. So yes, okay. Now, yes, the last thing I want to talk about is the midterm. Now, the midterm is is in next week. Okay, so I'm expecting you to spend just 1 hour on the midterm because we need to spend another hour on learning a new chapter. Okay, so there will be 15 multiple choice questions and 1 written question. Okay.
15,
so,
1-5.
1-5, yes, 1-5.
Okay.
So it means I would like to keep them short, okay, because yes, we only have 2 hours, okay. Officially, we only have 2 hours, so therefore I would like to spend the second half of the class on learning a new topic, okay. So I would say, okay, it's because yes, we only have 15 multiple choice questions, so I'm expecting you to spend 30 minutes, okay. So okay. So if some of you guys, okay, mentioned that, okay, you want to spend a little bit more time, okay, so I really think, okay, 30 minutes is enough, okay. Let's try, okay, let's try, okay, you should, okay, because while I will maybe, okay, I'll be adjusting, okay, I'll be adjusting the number of questions that needs calculations, okay. So we make sure that, okay, less than half of those questions, okay, needs calculation, okay.
Okay.
Just to make sure that, okay, so that's 30 minutes is enough, okay, for 15, okay, because if I have many questions that needs calculation, of course, that's not enough, okay, so just, okay, I will try to, okay, so maintain, okay, the number of multiple choice questions that needs calculations less than 50%, okay. And for the written part, okay, so things will look like these discussional topics, okay, so it means basically they are open-ended question, okay, so it means there's no exact answer, okay, so no, it will not look like A, okay, obviously, okay, but yes, maybe things like B or C, okay, I'm not saying okay, so the question will be the same as this, but the kind of question will be similar, that is, well, it will be an open-ended type question, okay. So I want to remind you once again, okay, so the main thing I want to look for is, of course, your knowledge, okay, on that topic or on that question, okay. But in addition to that, okay, so I also want to look for your the critical analysis. So it means if you can only quote, okay, so what you learn from the textbook, what you learn from the class, okay, you may just be able to get a pass. Okay, if you want to get a better grade that is more than 50 marks, okay, so then you need to show me a strong and critical ability, critical thinking ability. Okay. So yes, your midterm will be a combination of 15, okay, 15 multiple choice questions plus 1 written question, which is an open-ended question.
Professor, do we have a weekly quiz for this week 6 or no?
No. I think you cannot find it, right? You cannot find it.
Yeah,
because,
we can't find it.
Right? Because
Okay.
you're not required. You're not required to do the weekly quiz.
Thank you.
Because I know you need to spend time to prepare for your midterm, right? So no weekly quiz.
Yeah.
You're right.
Thank you.
So, Professor, for the midterm, we're to study all the topics that has been taught, or only financial analysis?
Yes. No, maybe okay. So let me show you. Okay, let me show you the thing. So it will be everything from day 1 to today's class. Okay, now let me show it to you. So it will be from day 1, which is class number 1 here, right? All the way to class number 6, which is today's class. Okay. To here. That is the financial statement analysis, chapter 3. Okay. So last time we learned chapter 2, okay, and we also learned the other chapters. Okay. So remember, okay, so your midterm will cover from week number 1 to week number 6. Okay. So only 15 multiple choice questions, not a lot, just like the quiz actually, plus 1 written questions.
Thank you.
Okay, yes. So just like what I said, okay, I always, okay, like to strike a balance, okay. And also, okay, I'm expecting, okay, so the average will be somewhere 70 something percent, okay. So I'm not expecting everyone to get 80, 90 marks, okay. That's not good, right? And also, I don't want to see everyone get 50, 60 marks. Okay, so I will strike a balance. Okay, so yes. Okay.
Professor,
of course, okay, if you do well, of course you can get a better grade, of course. Okay, but well, what I mean is that just the expected average should be 70 something, right? Yes. Question.
Professor, how much total time you will give for the both 15 multiple choice question and 1?
Yes. So yes, I'm expecting you let's spend 30 minutes on the multiple choice part and 20 minutes on the written part. Okay, that should be enough. 20
so total it would be 50 minutes.
Yes. Okay. Or 20 or 25. I forgot. Okay. This will be 20 or 25 for the written part. Okay. 20 or 25. It doesn't matter. Okay.
Professor, how long we have to write the question, or like the second question?
Yes. So that's a good question. Okay. So I will say, okay, because you only have 20 or 25 minutes. Okay. I'll double check. Okay. You only need to write 1 or 1.5 page. Okay. Because well, this is the physical limit actually. Okay. So because well, you need to write things. Okay. You cannot write a lot. Okay. If you only have 20 something minutes to spend. Okay. So don't write too much. And also don't write just one paragraph. Okay. So the main thing is you need to show me your critical thinking on that topic. Okay. This is very, very important. Okay. If you're not showing me that critical thinking, okay, so you will get low score. Okay.
So is it like, do we have to write in a separate Word document and then submit it, or just